It's great to be with you again. My name is Demetrios Xanthos, and I'm the principal of Sax Insurance Agency. Again, I'd like to personally thank NETA and HOA organizers for hosting this event, as well as I'd like to thank every one of you who is taking the time out of your day for your association to be at this meeting. I don't think you get enough credit for the time that you volunteer for your association. So today, I am going to touch on the state of the insurance marketplace, and I'm gonna look to do that in about 5 different segments. I want to do a brief recap. I want to talk about the current state of the marketplace. I want to talk about how you can be affected based on the segment that you may be in. Meaning, are you a new association? Are you a 50-year-old association? How is your association constructed? Are you frame? Are you masonry non-combustible? I want to talk about the options you may have this year. And then last but not least, I want to give you a glimpse into what I believe is the long-term outlook. All right. So let's start with a brief recap. Last year when I visited with you, and this goes all the way back to 2019, we knew in 2019 that the market was shifting from what they call a soft insurance market to a hardening market. And as we've discussed in nauseam over the past few years, the ramifications and what was unforeseen in the global pandemic and how that brought a tremendous amount of money supply into the global economy, how we have now experienced hyperinflationary periods for goods for the past 2 to 3 years, how the basic economic principles of supply and demand, how associations are being built now in almost every state. Therefore, the demand of association insurance products is up, right? So when we talked about this last year, these were all of the things influencing the marketplace and being more expensive and a tighter restraint on how insurance was being sold. Now, that's still all in play, right? The cost of things are still expensive. Carriers still believe it's more expensive to rebuild your community this year than it was last year. And so what's changed from last year to this year? Well, the biggest thing that's changed is we've now lost even more supply. Okay, and as I get into this segment, I am by no means in any way disparaging the decisions companies are making, and it is just a reflection of our times. But there's 2 carriers that are really having a significant impact in the state of California this year. One of them is Farmers, and it is universally known now that they identified to the California Department of Insurance that effective 1/1/24, they will be automatically non-renewing any association they insure that's older than 30 years old, and they will categorically be non-renewing any community that has a single building value or a total building value of 25 million or more. Now, that's extremely significant because Farmers Insurance and they have different insurance companies, Truck, Mid-Century, Farmers. They were the largest condo writer in the state of California. So you're talking about one of the largest supply lines to association insurance is reducing what they will and what they won't write. Secondarily, we all know Travelers Insurance. Travelers is taking a little bit of a different direction, but it's still having the same impact. They, like Farmers, have insurance companies, Select, Middle Market, and National. And so what they've done is they've restructured where if your community fits that same mold, older than 30 years old, greater value than 25 million, they're taking you out of their select product, which is a very aggressively priced product. And they're either non-renewing or they're drifting you over to their middle market. And their middle market tends to be more expensive, right? So at the end of the day, if it hasn't arrived at your doorstep, what will be arriving at your doorstep this year is either a notice of non-renewal or a notice of non-renewal with a significant increase. Now, why is that important? Well, that has the propensity to blow up your budget, right? And so for those of you in the audience today that have already experienced this bumpy ride 2 years ago, you're better positioned, and the impact is going to be as great. The reason 2024 is so critical is most of you, based on what I've just shared, 30 years or older, or have a total value of 25 million or more, you are about to experience a cataclysmic change in what you're used to paying. And so, as for some examples, we've had associations and I know we're in the first 2 weeks of January, but we've already had associations that were insured for 100 million, paying a premium of around 170,000 a year, now having to pay $1 million a year for the same coverage, right? That is probably one of the most extreme experiences I've experienced to date. I've seen some associations go from 70,000 to 540,000, but this one is big. Now, what are the factors surrounding and driving this? Well, in the state of California, putting aside capacity right now, supply and demand, it's high brush, right? So almost every carrier is now looking to 2, if not 3 different third parties to obtain what they call a brush score. The brush score can range from 0 to 100. If the number is closer to 100, you're in a pretty high brush area, and you're probably not even insurable. And it's going to take even someone like me, who's an independent agent, who has been an independent agent for over 20 years, works with over 30 different markets, and what may have been illustrated in my introduction, we operate in 9 Western US states. So we operate from San Diego to San Francisco, as far east as Kansas City, Missouri, right? So you are not alone in that. Your fellow board members in the 9 other states I operate in, they're experiencing the same situation, but it's just a little bit more heightened here and in some other Western US states where brush is prevalent. Now, when I talk about what do you need to prepare for, it is really critical that you interacting with your manager get a good handle on when your insurance renewal is coming. When is it coming? And you want to make sure that there is either dialogue with the existing agent or dialogue with the existing agent and other agents at least 90 days out from renewal. Because what we are finding is some associations, for whatever reason, are being informed of this dramatic change to their insurance policy, not in a timely fashion. And then that's putting the board and the community in a very awkward situation. So it's critical that you get a hold of when is your insurance renewing, and you make sure that there is dialogue at least 90 days out. Now, I talked about segments. What does that mean? We briefly touched upon this last year. You either fit into what I call one of 3 to 4 categories. You are currently on the board of a community that is either built in the last 15 years, So you're a newer community, you are fully sprinklered, meaning you have a fire suppression system that is designed to not only prevent or provide people more time to get out of the building, it is actually designed to suppress and put out the fire, right? Those segments of the business class are most desirable and what most carriers are fighting over, right? So doesn't matter what brand name you want to say to me, and I can name them all. They're all fighting for that segment of business. That is the most desirable. Built within the last 10 to 15, fully sprinklered, modern composition and construction. That's what everybody's after. That second segment falls into 20, 30 years and older, probably frame, meaning wood construction, can have a variance of roof types, may or may not be sprinklered. The sprinkler system may be designed for suppression. The sprinkler system may be an older sprinkler system that's just designed to give people more time to get out, known as a life safety sprinkler system, but the building's still going to burn down. Okay, those communities, those segments, they can be greatly impacted based on much more than that. So when we now receive a submission that looks like that in that segment, the insurance underwriters, they're looking for a lot more information than they ever have. They're looking for an updated reserve study. They're looking for a current fiscal budget. They're looking for a current reserve balance. They are looking at what is the financial state of this association. What does their reserve study look like? How many years does their roof have left? How many years does their siding have left? Do they have the adequate funds to keep this community in tip-top insurable shape? Okay, and so the financial health of an association as it relates to insurance has never been more front and center. And so if you are a community today, a board member on this meeting, I cannot stress to you how important your financial health is. If you are ill-funded, if your monthly assessments have been historically low, if you know you have things coming up to expiration and you don't have the funds to repair and replace, you have to face this head on. You know, you have to work with your association manager, you have to work with association counsel, and you need to do what's right to get your association in a better financial position, because otherwise you're going to be punished by the insurance companies to the point where you may be uninsurable by an admitted market, right? Those brand names you've come to know, and forced out into the excess and surplus world, which it's not that it's horrible, but the reality is you probably have never heard of these insurance companies. They're financially strong. Their coverages tend to be not as good as your standard markets. And they're much, much more expensive because they understand that you are not a good to excellent risk, right? So you are paying for that. Moving on to the third segment, this is a community that is older than 40 years old and highly likely has no sprinkler system in it. These communities are the communities that are really being disproportionately impacted by the pricing increases. Furthermore, if they tend to be in that brush area, and you know, right now, insurance companies, if you have a brush score of 50 or greater, that is kind of the tipping point, whether or not they want or do not want to look at you, right? So if you are in that first segment, newer, fully sprinklered, and have a brush score of 50, you have a decent shot at a standard market. If you're in that second segment, and you are financially strong and your community is well maintained, I think you've got a viable shot at a standard market. But if you're in that third segment and financially strong and the community is well kept, I'm not sure there's a place for you in the standard market in today's marketplace, right? So we've got the new, we've got the middle, and we've got the older than 40. So what are our options this year to manage, maintain a possible reasonable price? Okay, so the best option you have is going back to what I've stated. You're a well-funded, well-maintained community, and you are attractive to the standard markets to be one of their clients. If you don't fall into that category, you're going to have to start pursuing some other avenues. You're going to have to start looking at higher deductibles. Insurance companies have gone a step further, and they have now routinely are gravitating to what we call a split deductible. Well, they will have one deductible for fire, wind, hail, and then they will split off and have a separate higher deductible for cover water losses. Now, why do they do that, and why would that save me money? In a study, if you look at a community that is older than 20 years old, for every 10 claims, 6 to 7 of them are water related once the community is older than 20 years old. So the propensity of claims that come in on older communities are water related. So the insurance companies, by splitting off the deductible and making the water deductible higher, they make it more palatable for them to insure and easier for them to give you a better premium. Now, there's some other carriers that have taken it one step further, and they're not only splitting the water deductible off as separate and higher, they're also applying it at a per unit level, right? That means that if the water deductible is $25,000 per unit, then if it is a water loss, that deductible of $25,000 will be applied to each unit. Okay. Why is this important? This is really important because this is predominantly what's being offered to the second and third segment types in our condo marketplace. That then leads me to, what else can you do? It's really important, depending on the age of your governing documents and whether you're in the process of rewriting them or contemplating rewriting them, most of the governing documents really handcuff the board members of the association because they typically read the HOA must purchase a policy equal to 100% replacement value of all common area interests, right? So the board has no wiggle room to purchase anything but. Now, what we've seen over the last 2 years is that association attorneys are seeing that this is putting associations in a real tough spot. And what I've seen them start to do in rewrites and newer documents, and I want to read this and plant the seed, is the board shall make every reasonable effort to obtain and maintain the insurance policies as provided in this section. If the board is unable to purchase a policy, or if the board believes that the cost of the policy is unreasonable, the board shall call a special meeting of members to determine what action to take. So this is the type of language that we need to start seeing in our governing documents, so that if you are one of these associations pressed with the challenge of going from 70,000 to 700,000, you have an option to bring membership together to see collectively what it is that you want to do moving forward. And that is one option. And again, that's working with legal counsel. That is working with, are you in the process of rewriting your governing documents? So that is an option, right? So we've talked about deductible. We've talked about what do your governing documents say. The other thing that you really need to prepare for is that most associations do not have this surplus of cash just sitting around. And or if they do, it's allocated for those things that are coming up to be repaired and replaced. So we are seeing a much higher number of associations special assessing for the shortfall of the new insurance premium. That is something that you want to have a discussion with legal counsel with. You want to have a discussion with your manager about, because that is, again, something you're going to want to get in front of. You don't want to be scrambling to get out the assessment. And it leads to my prior comment, right? If you're aware sooner than later that you are an insurance segment that is going to fall into this unfortunate current situation, the sooner you can begin working on it, the sooner you can get the notices out and begin to collect the money for this additional cost that's going to be necessary. Look, long-term outlook. In our particular state, well over a year ago, our Department of Insurance, along with the governor's office, formed a committee, and I think we might have talked about this last year. And that committee was to look into the legal definition of wildfire. Could the state come up with and adopt a legal definition of wildfire? Now, why would that be so critical to the long-term health and the affordability of association insurance in California? Well, as we've been discussing throughout this, a lot of what's driving the price increase and a lot of what's driving the carrier's behavior to exit segments of insurable business is they do not want to be caught on a $50 and $100 million wildfire loss for one association. So it had some momentum early. My conversations with people is that momentum has fizzled. But long term, if the state could ever actually agree to and adopt a legal definition of wildfire, what does it mean to be a wildfire loss, and then deem it catastrophic, okay, we could begin to treat it like our other catastrophic risks, quake and flood, right? If we did that, and it could take some time, all of these carriers, like they've done in the past, they would take the state's legal definition, copy and paste it as an exclusion, right? So they would be able to step out of the way of this segment, clearly defined wildfire exposure. Now, why would that help the associations? By deeming it catastrophic. Most of our governing documents read that the HOA is responsible to make sure there's policy for standard and broad form perils. So by deeming it catastrophic, it is no longer a standard peril, right? So that saves us a lot of time in having to address what our governing documents say. And if that's the case, we will then start treating wildfire like we treat flood and earthquake, in that you decide. Do you want to buy full limit? Do you want to buy a sub limit? Do you want to buy a fixed amount? And therefore you regain control of that exposure, as well as I think you would see a flood of capacity come back to the state of California, right? Because they would then no longer be worried about being caught in hundreds of millions of dollars of loss due to wildfire. Now, again, this is just merely based on affordability. We know wildfire is real. We know what it's done to our state. We know what it's done to segments of our state. So it's not like this is a fix-all. All this does is possibly bring some affordability back to the marketplace, and then place the onus on the individual insured, that HOA, to decide how much of this coverage do we want, right? And we already do this for earthquake. We already do this for flood, right? So for those communities that I insure that are near coastal, or are in an urban area where they're at the bottom of a steep street, right? We've got a policy for a sublimit, right? Because the entire 15 stories isn't going to be impacted, but possibly the first few are. Same with earthquake, right? We've got some of you in the audience right now that you do not have an earthquake policy that fully insures for all 46 of your buildings falling down due to earth movement, right? You possibly are insured for 10, 15, or 30% of your community's value because you don't believe the community, or based on the information you've been presented, hopefully, that you don't believe the likelihood is very high of losing all of your buildings, right? So when we put it into that context, it makes sense. But again, that is not a solution that is on the table right now. Lastly, there are some insurance companies who I'm gonna use the term rolling the dice. They're rolling the dice. They've already unfolded a policy form, which in that policy form, they've created their definition of wildfire, and they'll be asking you to accept knowingly that based on this definition they've outlined, the coverage is excluded. That I think these are companies trying to get out in front of what they think is coming. They want to be seen as the market leaders. The problem I have with that is that that's not going to stand up in court, right? Because that's their definition. Our state doesn't have that. Our state doesn't recognize between a matchbox fire and a wildfire. Fire is fire, right? So if you're presented with that, understand that there's some challenges to that. But if from an affordability standpoint, that's what appears to be the best for your association at the time. I don't, again, I would consult legal counsel on what they think is the best option for you. So look, in conclusion, I know that this probably hasn't been one of your favorite segments, but I think people should understand what's coming, what's happening, why it's happening, and listen, don't forget, I've spent this entire segment talking about property insurance. Please don't forget, you have several other categories of insurance that need to be evaluated. You have your general liability portion, your slip, trip, fall, pool, spa, tot lot, sports court, man-made lake, whatever amenity your community has. You have your crime coverage to cover the association's fund and your reserves. You have directors and officers. That coverage does not come in one size. That coverage can come in various different ways. A pure duty to defend, whether the allegation is groundless, false, or fraudulent. Are the defense costs inside or outside the limit, right? Payrolled or non-payrolled workers comp, flood, quake, right? So you have a lot to deal with, but the primary issue right now is affordability, is capacity on the property side. The sooner you get out in front of it, the sooner that you're a community and a board aware that you will be facing this challenge, give yourself enough time to find the best solution for you. I hope this has been helpful, and thank you as always for attending this event.